Hello everybody, what's going on? NIO has officially set the date for its Q2 earning call, September 1st, right before the US market open. But as you have probably seen in the headlines, Wall Street is already hyper focusing on significant detail. NIO missed its Q2 delivery guidance. Now let's look at the raw numbers. Management originally guided for between 110,000 to 115,000 vehicle deliveries for the second quarter. The actual reported figure came in at 107,600 units. That is a miss of roughly 2,300 to 7,300 vehicles, or about 2% to 6% below their lower and upper target. Naturally, because revenue guidance was tied to those higher delivery ranging from 32.8 billion to 34.4 billion yuan. Top line revenue for the Q2 will likely land right at or slightly below the bottom of the band. When short term traders see a guidance miss, they react instinctively. But if you dig just one layer beneath the surface, the story shifts dramatically from a red flag to a massive operational expansion. First, put that 107,600 delivery figure into perspective. Year over year, that represents a massive 49.4% growth in deliveries compared to the Q1 of the last year. More importantly, look at the month over month trajectory within the quarter itself. In April, NIO delivered 29,356 vehicles. In May, that surged to 37,700 units. By June, deliveries hit 40,597 units, up nearly 63% year over year. This isn't just a company slowing down, it's a production machine ramping up. Furthermore, NIO is no longer just a single luxury brand. Their multi brand strategy is executing right before our eyes. The mass market Onvo brand doubled its monthly deliveries from 5,352 in April to 11,743 in June. Meanwhile, their compact EV brand Firefly expanded from under 5,000 units to nearly 7,000 units in the same window. The core NIO brand maintained steady premium volume, growing to nearly 22,000 units in June. When you look at the sub-brand, the engine is firing on all cylinders. A key reason for this momentum is product rollout velocity. During Q2 alone, NIO launched two major vehicles, the Onvo L80 5-seat SUV and the executive ES9 SUV. The ES9 crossed 10,000 deliveries within its first 30 days, a record pacing for premium electric vehicle priced above 500,000 yuan in China. Add to that over 110 million cumulative battery swap completed. The rollout of their upgraded world model autonomous driving platform to 700,000 users, and a fortress balance sheet holding over 48 billion yuan in cash and equivalent. Now let's address financial health. Coming off Q1, NIO demonstrated serious margin expansion, achieving a gross margin of 19% and vehicle margin nearly 18.8%. Their net loss narrowed significantly year over year to 300 million yuan, while R&D and SGA expenses dropped significantly as operational efficiency kicked in. Management is targeting full year vehicle margin between 17 and 18%. This proves NIO isn't chasing empty volume at expense of profitability. They are building a durable high margin business model. And if we will look at the second half of the year, CEO William Lee's annual target implies full year deliveries between 456,000 to 489,000 units. To hit that, NIO need to average roughly 46,000 to 52,000 units per month through December. Is that ambitious? Absolutely. But two major macro tailwinds are working in NIO's favor. First thing is first half completion rate. In the first half of the year, NIO achieved roughly 40 to 42% of its annual target, the highest completion rate among major Chinese EV startups, most which lag below 40%. Second important thing, tax incentive demand. China is reinstating a 5% purchase tax on new energy vehicles starting January 1st. Historically, upcoming tax implementation trigger a massive wave of pulled forward consumer demand in Q3 and Q4 as buyer race to finalize order before the deadline. Big money is already positioning for this shift. Institutional SEC filling show major institutional buying. Morgan Stanley bought 12.7 million shares, becoming NIO's second largest holder, while overall institutional holding grew by millions of shares in Q2. So, in the end, I will say that a 3 or 4% delivery miss in Q2 is noise. The signal is nearly 50% year over year volume growth, expanding multi brand market share, disciplined spending, strong gross margin, and massive institutional backing, leading into a tax incentivized second half demand boom. If the market gives us a short term dip heading into or immediately following the September 1st earning report due to headline reactivity, long term fundamental investors should view it as a prime buying opportunity. The third growth cycle for NEO is getting started, and the risk to reward ratio heading into late 2026 is looking exceptionally attractive. So, mark September 1st on your calendar. Watch those gross margin figures closely and keep your eyes on the bigger picture. With that said, thank you so much for being here. See you in next one.